Netflix just released their latest quarterly numbers, and to be honest, quite a strong quarter, good guidance as well, although revenue was a little bit weaker than expected. And so, with the stock being up over 30% year to date, up 35% year over year, stock is now down 2%. Nothing to freak out about. I believe Netflix will still be the winner in the streaming wars for years and years to come. The company is also going to become more and more profitable as more and more people sign up to Netflix, whether it's because of the password sharing crackdown or because they're offering the ad-supported tier, which of course is lucrative from Netflix standpoint. Now, right now, company has a market cap of $277 billion, forward PE 33.4 times, which for some that might be quite expensive, but the company is still growing its bottom line quite fast, expected to grow 53.6% year over year in fiscal year 2024, and then around 20-21% for the 2 consecutive fiscal years, meaning you're paying around 24 times fiscal year 2026 EPS. Okay, I think that's quite reasonable, especially if they can continue to grow 20% year over year. What do you think? Do you own Netflix? Do you think this is an expensive stock? Let me know down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe. If not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now let's dive a little bit deeper. Right now, with the rise of Netflix stock, we can see that forward PE, EV to EBITDA, price to sales, price to free cash flow, and even price earnings to grow, the stock is still cheaper than its 5-year mean. Why is that? Well, that's because the business has been growing top and bottom line faster than the stock has run up. The company is also generating more free cash flow and buying back more shares each and every year, making your shares more valuable. And so, for Q2, revenue increased 16.8% year over year to reach $9.55 billion. Operating income came in at $2.6 billion with an operating margin of 27.2%. Net income came in at $2.14 billion with diluted earnings per share at $4.88. Global streaming paid memberships increased 16.5% year over year. Net additions were just over 8 million, beating the estimates by quite a lot. Same as in Q1 and same as in Q4. Net cash provided by operating activities came in at $1.29 billion and free cash flow at $1.21. This was also one of the figures that were a bit weaker than previously expected. As for the guidance, for Q3, they expect revenue growth of 14% year over year. They expect paid net additions to be lower than Q3 2023, which had the first full quarter impact from paid sharing. For full year 2024, they expect revenue growth of 14 to 15%. That's up from 13 to 15% previously. They also expect 2024 operating margin of 26% based on FX rate as of January 1st, 2024, up from their prior estimate of 25% due to the improved revenue outlook and ongoing expense discipline. Their goal is to increase operating margin each year, though the rate of expansion will vary year to year. Now, switching to engagement and competition, this is where we get some useful figures. So according to Nielsen, streaming accounts for 40% of total TV time in the US today, with Netflix and YouTube the clear leaders in direct-to-consumer entertainment. Collectively, our 2 services account for almost half of all streaming TV watch time in the United States. In the first half of 2024, and despite headwinds from paid sharing, Netflix generated more view hours in the Nielsen top 10 across film, series, and licensed title than all of the other streamers combined. And here you basically have the list here. Number 1 is YouTube, 9.9%, Netflix, 8.4%, and then a huge difference with the rest. So Prime Video, 3.1%, Hulu, 3%, Disney Plus, just 2%. If you go down, 1.5% for Roku channel. I don't even see Apple here. They continue by saying Netflix and YouTube compete for people's time and attention. So looking to the future, they believe their biggest opportunity is winning a larger share of the 80% plus of TV time, primarily linear and streaming, that neither Netflix nor YouTube has today. Across streaming, pay TV, film, games, and branded advertising, it's an over $600 billion market, and today Netflix accounts for just around 6% of that revenue. So if you think again that you're late to the party, of course you're not early anymore, but you're definitely not late in my opinion, because I do still think that Netflix will remain the number one in the pure streaming business. YouTube, of course, is also in the streaming business, but YouTube is also including my own videos, which of course I appreciate a lot. Continuing here, they say that with 278 million member household and more than 2 people per household on average, they are programming for an audience of over 600 million. They will for sure announce when they reach a billion. That will be a huge, huge milestone. This is why they continue to increase the investment in their programming, even as many of their competitors are pulling back. Yesterday's news that Netflix was the most nominated brand for the 76th annual Primetime Emmy Awards, I didn't even know this thing happened, demonstrated the breadth and quality of our programming and the outstanding work of our creative partners. We've gained 107 nominations across 35 series, TV movies, and specials, including for dramas, etc., all the names here on the screen. So again, it shows you that Netflix, which was once a very, very niche thing with amateur-ish level, let's say, content, even though there were some pretty good TV shows, House of Cards being one of those, for example, now Netflix is dominating what they call today the crème de la crème awards, nights, whatever you want to call it. But if I can suggest one thing, if you like animated series but for adults, Blue Eye Samurai is definitely one to watch. And if you want to watch another movie, which I don't think it's on Netflix, go watch Only the Brave. It features Thanos. Well, the actor that plays Thanos, Josh Brolin. Anyways, moving on quickly to games. They announced here a couple of new games. They said that big games just like GTA can be on Netflix, etc. They say here that separately we will premiere a multiplayer game based on the Squid Game universe later this year, timed to the launch of Season 2 of their biggest TV series ever. I wonder if Season 2 will be as big of a hit as Season 1. I highly doubt it, but I hope so. As for advertising, they launched just over 18 months ago. They continue to scale their ad tiers, which now accounts for over 45% of all signups in their ads market. Its attractiveness, coupled with the phasing out of their basic plan in the UK and Canada, which will now start in the US and France, has increased their ads member base by 34% sequentially in Q2. Moreover, they say here they announced their new in-house ad tech platform at Upfront, which they'll test in Canada later in 2024 and launch more broadly in 2025. This will give advertisers new ways to buy, insights to leverage, and ways to measure impact. On the programmatic side, they'll also expand their capabilities this summer to including the Trade Desk, Google DV360, and Magnite. Given this sustained progress, we believe that we are on track to achieve critical ad subscriber scale for advertisers in our ad countries in 2025, creating a strong base from which we can further increase our ad membership in 2026 and beyond. But they don't expect advertising to be a primary driver of their revenue growth in 2024 and 2025. But remember, advertising is something that is extremely lucrative. Lastly, here as for cash flow and capital structure, net cash generated by operating activities in Q2 was $1.3 compared to $1.4 billion the prior year period. Free cash flow totaled $1.2 billion compared to $1.3 same quarter last year. They continue to expect full year 2024 free cash flow of approximately $6 billion, assuming no material swings in FX rates. During Q2, they also repurchased 2.6 million shares for $1.6 billion, and they have $5 billion remaining under their existing authorization. So yes, Netflix is now consistently buying millions of shares each and every quarter. And so we've reached the end of this video. The stock in the last 2 weeks or so was flirting with being overbought. We've had this with plenty of stocks that have gone up quite a lot this year. Took a little breather. We're now under the 20 and the 50-day moving average, sitting right now after hours at $632. The 200-day moving average sits quite lower at $563. The 50-day one is basically quite close, $650, and the 20-day one at $667. So overall, that's about it. Netflix still doing what it needs to do. If the stock goes lower, I believe long-term investors will profit from that. You can buy more shares of a great company at a cheaper price. That will be it for this video. Do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if not, and I'll see you all in the next one.